one of our students. So before going deep into the webinar and the welcome, I will just tell you how this webinar is going to go about. So you will have a session on the topic derivatives and financial market by Dr. Dhanu. After that, as per the request of the students of Mount Sinai College, last 10 minutes, I will be briefing about what are the eligibility criteria to join an MBA in Kerala, what are the entrance examinations. That was a request from their side, so I'm obliging to that. And then we will wind up the session. So I request MBA student of Ahilya School of Management, Marilyn Matthew, to come forward and welcome and introduce Dr. Dhanu to our audience. Marilyn, are you here?
Yes, ma'am.
Yeah, please come forward.
Good afternoon, one and all present here. First of all, I extend a very warm and heartful welcome to all for the webinar on the topic Derivatives and Financial Market, hosted by Ahilya School of Management. It is indeed my pleasure to introduce today's speaker, our dearest professor, Dr. Dhanu P., Assistant Professor, Ahilya School of Management. Dr. Dhanu completed undergraduate degree in BSc Computer Science, then in business administration, specialization, marketing, and finance. He did PhD in management, specialized in finance. I do feel that he is the person to take the today's topic, as Dhanu had done his PhD thesis, stock market, 2007 to 2008 financial crisis, and project on the topic fractal geometry and chaos theory in BSc Physics. Who else other than a person who has completed thesis on stock market and did a project based on BSc census can handle the topic? I welcome our Dr. Dhanu to start his session. So please.
Thank you, Marilyn. I request all the participants to please mute yourself so that the audio is clear to everyone.
Thank you, Marilyn.
Please mute yourself. Dhanu, I will just mute everybody so that the audio is clear to others. Just a moment. Yeah. Now you can go ahead.
Thank you, Marilyn. Thank you for the kind words. Okay, just a first, I'd like to thank our Ahilya School of Management for actually organizing this event and giving me the opportunity. Because I think knowledge increases by sharing. This is what all the wise men said, and I always say that it's always nice to give knowledge. This is the only thing that increases by giving. This is a simple thing that I learned, and all of us learn in our schools. Okay, and second, I'd like to thank Bindu ma'am, who has actually done a lot of things to organize it, and also the principal of Ahilya School of Management, who actually said that it's a great opportunity for you to share your knowledge. Ashok sir, thank you for giving me this opportunity. I also like to thank our academic director, Sri Mahadevan Pillai, who always encourage faculty to take more and more seminars so that we learn, and also by giving us even everyone is learning more things. So this topic, derivatives and financial markets. So I guess most of the people know what exactly is a financial market. Because the reason why I say is because we all heard about stock market.
I'm sorry to interrupt you. A few participants, if the voice is not clear, maybe you can keep your mic very close to your mouth so that it becomes clear.
Okay.
Yeah.
Okay, fine. Now it's okay. Is it? Am I audible?
Is Dr. Dhanu audible to all of you? Thank you. There are a few S's coming, so it is fine. Thank you.
Okay, thanks. Great. Okay, let's. Okay, so what I was telling you is that what is a market? Market is a place where buy and sell. Now, I use the word financial markets because you find the derivatives in financial market, but actually it is more than financial markets. But more or less, we learn it, especially in MBAs and BBA, BCom. People learn it during the time where they learn investments. Okay, so let's understand what exactly is derivatives and why it is used. Now, you all heard about this word risk. So what do you mean by risk? Risk means uncertainty, right? Uncertainty whether some prices of shares or say a commodity like mangoes or gold, something goes up or down. Now, risk is actually two sides of it. For example, I want to buy gold. If the prices go up, it is definitely not good for me. It's a risk for me. If I want to go and sell gold, prices should not go down. It's again a risk for me. So this is why I tell you, risk is actually two sides. Prices can go up and down. So if you want to buy a share, you want to buy it low. If you want to sell a share, you want to sell it high. Now, there are two types of risk. One is business risk and financial risk. Now, we are dealing with primarily financial risk. So, just to talk about business risk, is like a recession is coming, or there is a competitor, there is no demand for your market, there is a strike. All those things are business risk. So, financial risk is like currency risk, price fluctuations, then interest rate goes up. All these things are part of the financial risk. And what derivative does is that it tries to mitigate the risk. So if if there is a person like me who have a kind of financial risk, is there any way that I can transfer to somebody? If there is somebody who want to buy that risk for some price, this is what basically derivative is all about. It's about risk mitigation. We won't say that risk, making risk zero. Rather, you spread the risk. If there are 2-3 people, let me spread it to some other people. This is the basic concept of derivatives, and risk management itself is about how can we reduce it, or how can we mitigate, how can we give it to somebody else. This is the thinking that generally we have in the financial markets. Okay, let's understand the word derivatives. So derivatives is a contract between two or more parties whose value is based upon agreed upon underlying financial asset, like security or set of assets like index, like BSE Sensex, NSE. These are the indexes we have. Or we can have instruments like bonds, like commodities. What are the different commodities? Commodities like oil, gold, silver. These are things we know. There are other commodities like agricultural commodities. For example, mangoes. For example, rice, vegetables. Or probably if you have ever gone through a newspaper, you can see quite a lot of commodities in that. Like rubber. If people are from Kottayam, they will be very much interested in rubber, turmeric, pepper. These are all kind of commodities. Currencies like US dollar, Indian rupee, euro, yen. Like if I am there, one of my relatives is in Middle East, UAE, dirham, Saudi riyal. All these things are if currencies go up and down. That is also an issue. I'm an exporter. See how currencies come into play. If I am an exporter, if currency prices come down suddenly, I'm an exporter, and suddenly I export something. It will take some time to reach there. Once they reach, probably they'll give you money after 3 months. If the price, if the rupee value actually increases and commodity, the foreign currency goes down, then I'm losing a lot of money. If 5% currency is going, it's a loss for me. Interest rate. This is also kind of thing because by interest rates, we have time. We'll go to that. Market index we already discussed and stuff. So these are basically what our underlying currency is based on. That you are creating a derivative contract between two people. So basically, what happens to the underlying asset, be commodity, currency, based on that, the price of your derivatives actually keep changing. Goes up or down. Let's go to derivatives. So probably people who are from finance, mathematics, they know derivatives like differentiation, integration. This is not like that, but a lot of differentiation actually goes into it. Differentiation and things like that is going into it, which we are not touching today. So how do you measure distance? So derived from the measurement of distance in miles. So if you have a mile, how much is a kilometer? You multiply by 1.61, you get kilometers. Or if it is Fahrenheit, how you convert into Celsius. So it is something like that. Something is underlying it, and based on that, you are calculating. This is, in a sense, this is what you should understand. So it was originally developed for the meeting the needs of farmers and merchants. If you look at the history of it, most of the derivatives, the history goes to farmers, and especially in US, they try to sell corn. So I cultivate corn today. Tomorrow somebody want to buy it. Let me go. So for that we will go for a derivative. We'll see that in the next slides. So Chicago Board of Trade was first derivative market established in 1948. So it's also later named as Chicago Mercantile Exchange. And in India, we have like Multi-Commodity Exchange, National Commodities and Derivative Exchange. We have like BSE, NSE, all these places where actually derivatives are traded. So, okay. So the simplest derivative is called as, or like basic thing is basically we call it we cannot even call it derivative, but it will give you an idea like what exactly is a derivative contract. So it's a forward contract. So imagine like we are in Palakkad, so there is like huge mango farmers. Now, what will happen to mango farmer? If I am selling it for say 20 rupees, it's a profit for me. I'm a mango farmer, and there is another company who is like making jams, the mango jams, or like you can put juice also. I just took a picture of jam. So you could take also fruity like fruit juice also. So they want to buy mangoes. Now, if for them also, if you get it for 20 rupees per kilogram, it's okay for it. If, for example, as a farmer, if the prices go below 20, below 50, somehow we'll manage. If it go below that 10 rupees, it's a loss. So I will not be able to make a profit. How will I pay my laborers? How will I pay for the pesticides and other things, processing costs? I will go broke. Probably, farmers will have to generally nowadays, they, what they're doing, right? They suicide. So this should not happen. Take the other side, jam company. They make also juice, also mango juice. Now for them, if the prices go about 30, they are going to lose money. They find it difficult to somehow manage their cost. Cost goes up and they go bankrupt. So what they do is that, and this mango farmer and the jam, both of them, one of them want to sell mangoes, other want to buy mangoes. So now I can see I've cut, this is season, so I can see the buds of mangoes coming. I know that in the next few months, you put it next 2 months, I'm going to produce, say, 1 million kilograms of mangoes. And the other person, they want that 1 million kilogram of mangoes. And what they do, they come together and agree for a price of 20 rupees. So let's calculate it. So basically that is 20 lakh. So at the harvest, so imagine like it is after a few days, after a few months. At harvest, you will go to sell it for 20 rupees. Irrespective of what happens, they will end up exchanging this money. So farmer will sell 1 million kilogram of mangoes. They will buy it at 20 rupees. What will happen if the prices drop below 10? Still, they honor the contract and sell it for 20 rupees. If it is for 30, again they will go for 20 only. So this is basically what forward is. It's nothing to do with today. It's about what is going to happen in future. And now itself we are actually making an arrangement. Okay, so what are the advantages of forward contract? Now this is a very simple thing. The main advantage is that there's an upfront fee, so you don't have to pay anything, right? So risk due to currency fluctuations are completely eliminated. So I don't remember, right? So something like it is between two countries. Imagine like one is in India and the other is in say Dubai. What if the currency fluctuates? People are going to lose. Even that will be eliminated because everyone we agreed upon already. So forward and over the counter products. So what I mean by over the counter products is that you're not doing it over a standard process, rather by one-on-one basis. So that's basically over the counter. So you are going and buying it from say counter. Basically means a standard place merchant. They'll give you 1 kilo of something. Price chart they already. So you go to a fruit shop and buy 1 kilogram of apple. it will be listed on the top of it, and you'll get it for a price, and everyone get the same thing. Here, this is between two parties. So what they can say that, okay, let's agree for 21 rupees. It's fine, but in the exchange, it is not possible. And it offers a complete hedge. Hedge means protection. So I think you have heard this company called as Hedge Equities, right? Basically, the meaning of hedge is protect, complete protection. The reason, the last is it's easy to understand. Not much complication in this going, because going forward, little bit complications start coming. So what is the risk in forward contract? What is the risk? See, what if farmer or the jam company who's said that we are not going to buy it? We call it the counterparty risk. So if I am the farmer, the counterparty is the jam company. For the jam company, the counterparty is the farmer. So both of them can default, right? Both of them can say that we don't want it. The next is no standardized size. I talk about 1 million could be say 15 million, or it could be even 100,000. Somebody want 100 kilo only. Imagine that is a small shop who want to make a little bit pickle. For them 100 kilo for this year is okay. But is it possible? No. And so it is not traded in a recognized stock exchange. So what the exchange does is it has a huge market. So people from anywhere can buy it. So here, if there is a farmer, there is a jam company, they have to come together face to face, do it. Maybe there will be a broker, but generally that is not in forward. It is not even coming, and that's how they negotiate. And second thing is it is difficult to find counterparty. If I am a farmer, I cannot go. Look for the jam company always, or like if the jam company is located somewhere else, or somebody who want to buy it is not there. So that is kind of it's what you call it. Difficult in finding the counterparty, the other party. So if a jam company, how will I find out if I want 1 million kilograms, where I get such a big farmer? It's difficult to find such a big farmers in Kerala. So these are the problems generally with the forward contract. Now let's go to the future contract. Here it's a standardized contract. So it is like standard. So anybody who is going to buy it, it's kind of a same thing. And this is through an exchange, through a clearinghouse. What do you mean by clearinghouse? It's a kind of a broker. So you have a stock exchange, you have a broker. So for example, when we go around, you can see like companies like Hedge Equity, then India Infoline, then Sharekhan. These are like the clearinghouses, the brokerages. And exchanges, there are only two exchanges we generally know. One is the BSE, second is NSE. We have like Cochin Stock Exchange, then one is in the Coimbatore Stock Exchange. They are there, but generally we know there are only 2, 3. If it is foreign, it is like New York Stock Exchange, then London Stock Exchange. So these are the stock exchanges. And brokers. Brokers is like we go and approach it. What it does is it actually avoids, or it actually reduces the counterparty risk through margin money. We'll discuss it later. So future, it's originated in Japan during the 18th century and was primarily used for trading rice and silk. So I told you, right? Then it actually started in commodity exchange, but it started getting popularity in the financial markets. It's a standardized agreement between the seller, the short position of the contract, and the buyer is a long position. So in the financial term, short means sell, long means buy. It's a very simple. The short means sell, buy means so long means buy. So we call the seller the short position. It is like he's going to sell it. Buyer, the long position means that he's ready to buy it. So the future date is called the delivery date or the final settlement date, and the preset price is called the future price. And the price of the underlying asset on the delivery date is called the settlement price. So on that day, what is the price? It is called the settlement price. Okay, let's understand. I just put today's rate. Just imagine, just go to the thing that like last week we bought the mangoes, right? So what happens is there is a standard rate. So we are selling at 20 rupees per kilogram between party A and party B. And it's like, so it is not just actually one contract. So party B, he said that I'm going to sell it to party clearinghouse A. The other is the party A is that I'm going to buy it. So he said the buy means the long position, sell means short position. So it is actually two contract, and so the clearinghouse actually they act as a risk mitigator. So what the clearinghouse does is that they make sure that this contract actually is actually executed. So people, whatever is a quantity. So whenever we say quality and quantity, so quantity means, say, for example, this cone is A quality for say 20 rupees, 25 rupees. A plus, so 30 rupees. So it's like that. It will be predetermined, and the quality based on that you can have a delivery on a future date. So if A and B have a contract, the clearinghouse actually makes sure that this contract is executed, because party B will say that, okay, I have a long position, so I want to buy it. Party A said that long position, buy it. Party B said that I'm short position, so he's going to sell it, and they come in between and they'll make sure that the order actually is executed. Okay, so we talk about margin money. So this is something that we have to understand. A little bit maths, I don't think it is very complicated. Generally when you make a kind of a presentation, make sure that the less maths better, but since it is derivatives, I'll put a little bit maths. So imagine like you have like, so in the previous example of mangoes, so if you want to buy 100 kilogram of mangoes for 20 rupees, this is what is agreed, right? So you want to have an initial margin. So initial margin, I just put it 2,000 rupees. Generally, it will be a percentage. So for special stocks, it is 5%, and up to 10% also depends upon the stock. Stock is very liquid. It is 5 to 10%. It depends. So I give it 10,000 kilo mangoes, 20 rupees. The price of the total delivery will be 20,000 rupees, right? Now you look at the margin money, which is 2,000. So you can see the chart, right? You can see the table: seller, future contract, buyer. In the other side, it's a margin. So margin is margin. Then we have like under the future contract, we have the delivery price, buyer and buyer margin. Now go to the margin. So initially they agreed on some date, future date. Today I agreed on it, and the future price after 1 month, the price we agreed is 20. So 20,000 rupees. The margin is 2,000 by seller and 2,000 by buyer. After after a few days, the price actually drops from the future price. Not today's price, future price actually drops from 20 to 19. So what it tells us is probably there is a lot of supply. It's a season time, so a lot of people are going to come. So what happens with the seller? So actually what happens is that 1,000 rupees is added to it, and the margin for buyer is actually reduced to in 2,000, it is 1,000. So what the clearinghouse will do is that they take 1,000 from the buyer and put it on the seller. So that's how in the second column we have like 3,000 and 1,000. And after some time, what happens is again the prices drop below 18 rupees per kilogram. So the future contract is for now 18,500, and for the seller side, the money is added, another 500 rupees added, 3,500, and the buyer account 500 is reduced. Now once it hits a 500, we call it we said that maintenance margin. So 10,000 is a maintenance margin, and that below, if you go below, 1,000 is a maintenance margin. If you go below that, you have to add another 5,000, 1,500 to make it 2,000, and that's what it's shown in the yellow color. So below maintenance margin is 1,000. So the moment it goes below 1,000, another 1,500 rupees is added, and 2,000 rupees he has to maintain. Otherwise, it will be cleared by the clearinghouse. After some time, after 1 month, probably September 1st is the delivery date. So at September 1st, the price of the mango is only 10 rupees per kilogram. The seller will sell it at 10,000 rupees. Buyer will buy it at 10,000 rupees. But look at what happens with the margin. Margin for the seller will get 10,000 rupees. Buyer will give 10,000 rupees. So basically, the seller will get 20,000 rupees. Irrespective of price, what happens? Seller still get 20,000 rupees. Buyer still pays 20,000 rupees. Now, think about the flip side. What will happen if the price of the mango goes 30 rupees? Buyer will say that, do you think that the buyer will lose what? You have to give 30,000 rupees? No. The things will go flip. Buyer will have to pay 30,000 rupees, but from the margin money, the margin money will be reversed. So seller account will be given another 10,000 rupees to the buyer. So actually what happens is that irrespective of what happens, once you are entering this kind of contract, the risk is mitigated. Basically, the risk is being spread between the buyer and seller. Irrespective of what happens, the delivery thing will happen for 20,000 rupees and nobody is going to get hurt. And seller is happy, buyer is happy. I mean, this is so this is what I have told you. So the market price is 10 rupees per kilogram. The seller will get 10,000 by delivering the mangoes plus 10,000 from his future contract. If the market price is at 30 rupees per kilogram, the buyer will sell at 30 rupees and get the buyer will buy it 30,000 rupees and get from 10,000 from the future contract. So irrespective of what happens, people are not going to lose money. Okay, so there are a couple of things I want to discuss about the future position. So how is this going to deliver? So physical delivery. So means that if you enter a contract, it requires actually purchasing or selling a commodity. So for example, imagine that the share prices are listed on the stock market. Do you think that people will buy and sell mangoes? If actually it's a farmer, they will do it. But if you're just a financial investor, for example, a person like you and me, we will not go for specific physical delivery. So physical delivery is only for the real traders, and this is going to cost you like warehouse expenses, insurance costs, transportation, like we call it the shipping costs, brokerage fee. All these things are required. Now the other is called offsetting. Now this is a kind of an interesting thing. Now this is an example. So suppose Mr. A takes a long position in future market for long means buy for 1 kilo of gold from April month for 2,700 per kilogram of gold. On 25th February, he decided to close his position and hence entered another future contracts. Now the short position rupees at 2,800 per kilogram gold for the delivery of the month in April. So what happens is basically nothing. He is buying gold at 2,700 and then he wants to sell it after 1 month. So what he do is that instead of he buy long and buy 10,000 and then he buy a short position. So the net is between net is actually zero. He won't have any quantity, and the cash flow basically he get 1 lakh rupees. So actually that is one thing that actually happens. If you are an investor, you don't have to own anything. Rather, I'll buy a long position, say 1 kilo of gold for 27 lakhs. I take 27,000 goes from my account. That's what cash flow on April 30th is 27,000 minus 27,000. I pay 27,000. Next line to receive for short position. You're going to sell it. So quantity is minus 100 grams, means that you're giving away 1,000 gram, and 28,000 is coming to account. So basically, you make a profit of 1,000 or 1 lakh rupees. So this is what generally offsetting is all about, and this is what happens in the future markets. And the second is a cash delivery, like you pay money and take the delivery of it. Okay, next we go to another type of financial asset called as, or derivatives called as options. So there are two types of options called as call options and put options. Now call means you buy, the person who is having a call option has a right to buy the stock only if he wishes to want to buy it. It's an option, but the seller has an obligation to sell. So if I buy a call option, I have a right to buy. Also, I can have, if I don't want, I can reject it also. But the other person The seller of the call option, he has an obligation to sell. Irrespective of what happens, he has to sell it. And put option, the buyer option has a right to sell the stock only if he wishes to sell. But seller has an obligation to sell it, to buy it. Sorry, it's actually sell is actually sorry, it's buy sell it. Sorry. So put means sell, call means buy. So this is how you have to understand. So these are the two type of options that is available in the market, and we have like different varieties of it. It's called as American options and Europeans. I'm not going to get details into it. We'll just see how the whole thing works. Now you have a call option, so that means that I have an obligation. I mean, I have a right to buy it. So call option, the ABC company, it's a stock. So currently the stock price is 50 rupees. So current price is 50, and I buy a call option for 5 rupees. The strike price means the agreed price, and expiry is 1 month from. It could be 1 month, 2 months. It depends. It could be any date that required. Imagine the stock. Go to the look at the table. So end price or the future price, profit or loss if you buy the stock. If you buy the call option, what is going to happen? So call means buy it. So I buy it. So if you want to buy 50, after 1 month the price is 80. And what will be like if I want to buy it at that time? At present it's 50. After 1 month it is 80. So what exactly is my loss? If I would buy it today, and after 1 month it is selling for 80, probably I would have gained 30 rupees. But instead of buying today, I buy it after 1 month, I lose 30 rupees per stock. Now you buy a call option for 5 rupees. What it tells you is that I have an obligation. I have an option that I can buy it from the person who's going to sell it for 60 rupees. So I buy it at 60 because I have an option to buy it, and the market price is 80. So basically, how much I paid? 20, but already I paid 5 rupees for the option price, right? So by what I'm getting is only 50. And take the other side of it. If the price, so this is one thing about price options. Look at what happens if the prices go down. Instead of 50, it goes down to 20. After 1 month, prices go down to 20. And whatever the profit or buy, if you're going to buy it at that time, I mean, if you're going to, I'll be losing 30 rupees, right? Rather, I'll say that, okay, I didn't buy it. I could have got 30 rupees. But you have an option. So that I have an obligation to buy it at 60. So I said that I don't want to buy it, but still I'm going to lose only 5 rupees and I can buy it for 30 rupees. So 20 rupees and still I make a profit of basically 35. So this is basically what a call option is. So it is called as, if I'm making a profit, 15 rupees is called as the in the money. And if it is option, if I'm losing, it's minus 5 rupees, it is basically out of the money. So the thing about this kind of option is, respective of what happens, your loss will be only 5 rupees, the option price. The stock price is whatever happens, you're not going to lose a lot of money. Only loss is 5 rupees. That is how much you buy it option, how much you buy the option price. And what about the call option and put option? So I buy it for 5 rupees. If the prices go up, put means I have a right to sell it. I have to right to sell it at 6 rupees. So the option price is only call option. You're going to get 15. Rather here you lose 5. I think it is not 5. It is actually minus 5. And if the stock price is 20, if I buy the stock, I lose 30. I mean, if I want to sell it, if I go to sell it and the price is only 20, at present it is 50. After 1 month it goes to 20. I lose 30. But if you have this call option, you only pay, your put option. You have like 15 rupees in profit. And this is probably basically what the options is. So basically you have to understand is that if I am buying a put option, I have a right to sell it But other person, irrespective of what happens, even if he has to sell it for a loss, he has to sell it. So generally what happens is that we agree for the margin money, and just that you get the put option price. Now, a little bit we discuss about the credit default swaps, and you have to click. Sorry. Okay. So it's very similar to it's much more difficult, financial instrument. So you have a bank. So you have like a company, 1, 2, 3 firm, and it want to sell it. Sell insurance to, or you want to buy insurance to ABC Limited. It's a company, and there is a bank, for example, AIG. And what it does is that if ABC want to say, if ABC company you want to buy a bond for say $1 billion, and so the 1, 2, 3 firm want to sell a bond to ABC, and they will. ABC Inc. will give $1 billion to 1, 2, 3 firm. And what the bank 456 bank, what it does is that they're insuring the bond. What it means is that if the company didn't 1, 2, 3 firm, it didn't pay ABC, the bank will pay it. Only thing is that they will take 1% interest. So bond is selling for say 10%. And the bond is selling to ABC Inc. for 10%. So ABC will get 10%, and they sell that bond to, they insure the bond to the bank, and the bank at 1 rupee. So what happens to ABC Inc. is that they'll actually get 9%, and ABC Bank will get, so 456 Bank will get 1%. It's a kind of insurance thing. If 1, 2, 3 firm didn't pay, ABC will get it. ABC will get it from the 456 bank. So this is what basically a credit default swap is. So what it means is, if a 1, 2, 3 firm didn't pay the money to ABC Inc., 456 bank will pay ABC. This is the agreement. So this is what a credit default swap is. And imagine that there is so many players and buyers. If if 1, 2, 3 firm actually goes bankrupt, then ABC can take their money from 456 bank of $1 billion. So it's good for ABC, but if 1, 2, 3 is selling, not able to give it, 546 bank, it's a big trouble for them. And we'll understand like why this. No, this is very simple. What credit default swap is, but we'll just go and see how it is going to affect the housing market. So I was discussing like, is the derivative very good? What exactly is the problems of derivatives, and why it is having such a huge impact on the financial market? How did the 2007 financial crisis happen? This is a question that people always ask, and why it is so related to the derivatives market. See, you have to understand like subprime mortgage crisis. So I'll just discuss about like this is I got it from the Wikipedia. Just take it. So it's a bit cumbersome, but just make it simple. Subprime mortgage means you understand mortgage, right? Housing loan. Basically, the subprime mortgage. Mortgage means housing loan. So subprime means those people who don't have income, who don't have any other property. The bank will give loan to those people for very little collateral or no collateral. Only the house is a collateral. So people can go and buy the house without any collateral. The house itself is a collateral. You don't have salary. You don't have any other income, but still you can get it. Now, why did the government or why did this happen is because every government believes that the people, especially in America, just like India, it's a democracy. So people who have home, they believe that they'll vote for us. So just like a kind of a subsidy kind of a thing, they encourage the institutions like Fannie Mae, Freddie Mac to lend to these people. It is called a subprime mortgage because these are people who are below the prime lending rate, but the interest rate will be higher. But still, people believe that whatever happens, the land value will not go down. This is the thinking of the people. If you ask anybody, do you remember when the housing price or like house price or land prices go down? Almost everybody will say that house price or land price never go down. In my memory, it never happened. Even that happened to them. So imagine there are a lot of people who are going to buy these homes without any income, and after staying in the home for a few years, if the bank comes and says we don't have money, okay, no problem. At present, we sell the home for say 10 lakhs. After a few years, the interest rate is only up to what 13 lakhs, but the house will sell for 15 lakhs. Still, we can make some arrangement. If we give some money to you, we'll take the home back and sell it to someone else. But imagine that this is going to happen to everyone. So thousands and lakhs of people actually bought the home or get a loan from the bank, buy a home, thinking that this price of homes will keep on going. Now, the problem here is that if few people actually buy it, it's fine. But if everyone started, if few people don't have money, they sell it, fine. But everyone want to sell it, it is like, you understand, people who, you understand, right? If there is a lot of supply, the prices will go down. A lot of people want to sell their homes, price of the home started coming down. Okay, so this is a second thing. So this is what exactly happened to the. Previously we discussed about how the government was involved in it indirectly. So there are a lot of house. So what happens is house price started declining. So that means that I cannot refinance it. Basically means that I can give them I bought a loan for 10 lakhs, sell it at 15, and then somehow we can manage it. That started going down because people cannot. A lot of people are there who is going to sell only. Nobody is going to buy it, and this led to a lot of foreclosure. Now what happens is that when a lot of people are removed from the home, that is going to have a negative impact on the economy. So suddenly what happens is that mortgage cash flow decreases. So what happens now is that banks started losing. And once the banks started losing, then banks started losing, banks started actually defaulting. Now once this started, this is a problem we have discussed, right? When a company loses, suddenly the bank will come and started, in the credit default swap. If ABC company didn't pay the lender, then the bank will go and insure it. But here is the problem: when everyone is not repaying, suddenly the amount is so huge that banks started failing. So a lot of huge companies like Washington Mutual, like Lehman Brothers, we'll discuss it in the next slide, and that led to liquidity crunch. Now, what happened is that it didn't stop there. So what happened is that when a lot of banks, a lot of homes are there, when the subprime homes are there, they bundled it. So 1 lakh homes are there. So the cost of all the homes will cost you around say thousands of crores. They cut into small pieces. Basically means that they give it like 100 rupee share, and just like that, they start trading stock market. It's called as collateral debt obligations. So basically, instead of one home, rather you have like 100 rupee share. This is selling on the stock market, and a lot of companies started buying it. So the thing is that if everyone started repaying the loan, then the shares, the current obligations, the price will go up. If people start to sell, nobody is paying rent, and nobody is paying for the home loan, the prices will come down, and that is going to create a lot of havoc in the market. So this is going to have a huge impact, and a lot of banks and actually fall down. And what happens is that suddenly, when a lot of banks started falling down, credits stopped, and then it is having a negative impact on the economy. So people, if you cannot get bank loans, business cannot work, people cannot buy new homes. So what happens is that then the government has to step in just like today, they have to give, central banks started giving a lot of fiscal stimulus, and they started bailing out. In America, what happens is that they have to bail out private banks. There was so much of outrage against it. So the thinking is that if I make a profit, I keep it. If I make a loss, government has to bail me out, or taxpayer has to bail me out, and that is such a huge issue, even in a country like America. And then government started putting money and started giving a lot of funds to the banks so that the bank loans can be stopped. And then they started selectively choosing like Freddie Mac to bail out, AAG insurance. They started bailing out those kind of the government started bailing out those kind of banks, and it somehow the system has been restored. Now, why did how did it happen in Lehman? So we'll just see one case, which is the Lehman Brothers. Okay, so I told you, right? These are all certain bank loans, and based on the bank loans, if the people are paying money, the stock prices of that credit default swaps actually goes up in the stock market for 100 rupees or so. Imagine that. What Lehman did was they have a leverage ratio of 31:1. What it means is that if I have 1 rupee in capital, or like 1 crore as a capital of my company, I borrowed 31 crores. Imagine, I have 1 rupee, I borrowed 31 rupee, and they put this money into stock market, buying this, credit default swaps. So what happened is that if these people buy it, if the price has to decrease by around 3 or 4%, so that is going to wipe out all its capital. That's going to destroy the entire company, and that's how the Lehman Brothers went bankrupt. So it's about, this is not just one thing, there's one more thing. Okay, so what exactly did happen was, it's actually the worst case of derivatives, right? The derivatives was actually, do you remember where we started? We started from the mango farmers, right? How the farmers have future contract, how the swap, all those things are there. But when it became so much involved, and many companies are involved in it, the risk actually increases so much that it actually makes sure that and the companies in Lehman Brothers, they borrow a lot of money and invest in stock market to make a lot of profit. If the stock market the price has to decrease by 3 or 4%, so 100 rupees share, it is selling for 95. That's it. The Lehman went bankrupt. This is what happened. And then there is one more story of this called as long-term capital management. Now, long-term capital management, this is a hedge fund. So hedge fund, you should understand, it is like a mutual fund. The thing is that only wealthy individual can invest in it. So if I want to invest in a hedge fund, in American terms, it is like $1 million. Our minimum investment should be 7 crores, 7.5 crores if it is by today's exchange rate. So that is kind of only sophisticated investors can sell it. Now, this has 2 Nobel laureates. LTCM is a company which 2 Nobel laureates, they got a Nobel Prize in derivative itself. We didn't touch upon it. Glasgow's model, simply because it is beyond the scope of this talk. They were there, and what they were doing is, just like Lehman Brothers, they were having leverage to 1:30. So their capital is 1 billion, probably 100 billion, but they borrowed around, say, 100 to $1 trillion, and that is going to create such a problem again that it is going to destroy the entire financial system, because they borrowed and if they didn't give it, almost all the counterparty is going to lose it. And people have and the moment the trust is lost, people are not going to invest money into stock market, which for a world, it is actually a very bad thing. And because of that, I have to tell you that financial derivatives are actually good, but if you are using it for the wrong purpose, for excessive greed, for excessive leverage, it can create, it will become what I call it, weapons of mass destruction, or weapons of financial weapons of mass destruction. Just like a nuclear bomb, it can wipe up the complete city. It can wipe up the entire financial system. So always I want to tell you that derivatives are they good? Yes, if we are using it for the proper purpose. So by this, I conclude my talk. So let's go if I have any questions.
If you have any questions, you can either unmute yourself and ask, or you can put it in the chat box, and Dr. Dhanu can read it out and answer it for you. I know it is a very, very kind of mind-boggling topic. It's very somebody who is not from financial background. It is Greek and Latin to them. I totally understand that. So, students, if anybody, there are so many students from financial background. So, what is a cap price and strike price? There is a question here.
Okay, so we'll go here. Okay, strike price it's an agreed amount. So it is not cap price; it's actually the call price or call option price. So strike means we said that it's between two parties, right? Somebody who want to say, if it is a call option, I have a right to buy it. So the other party is have an obligation to sell. I have an option, buy it or not buy it. So strike price that's a price that we agreed on. Today I agree that we'll buy it at 60. And what will happen if the prices go up? I will still say that I will buy only at 60. So at that time price is 80 rupees. I can buy it at 60, and if the present price is 50, I'll make a profit of 20 minus my call option price, which is 5, which will give me 15 rupees profit. If the prices go down, instead of from 50, it is go down to 20. It's good for me, right? I want to buy it after 1 month. I want to buy it. Price is 20. If I don't buy an option, I'll make 30. Or rather, I'll say that as the person who is he's going to lose 30. But because I just buy an option, I can get it for my lose is only 5 rupees. The strike price is the price at which we agreed on already agreed up, which will be the transaction will happen after 1 month or whatever the future date.
Okay, so any more questions? If you have any more questions, you can ask him the same way. Sir, can you please once again explain housing bubble formation?
Okay, great. Okay. See, the housing bubble, we'll just go to the very simple thing. See, it happens at different layers. Okay, one is at the government level. So government, what they want to say, let the people of it's a democracy, just like India, it's a democracy. So people want to, the government want people to buy homes so that if have a home, people believe that they'll vote for my party. Republicans and Democrats both encourage it because they believe that whoever buy it during that time, they'll get it. So what happens is that we call it the subprime mortgage. Subprime means below prime. Below prime means people who don't have salary, people don't have any assets, they can buy home or they can get a home loan, only home loan from Freddie Mac and other housing companies. And after a few years, if they cannot repay back, just give them the keychain of your home. I mean, give the keys to your home to the bank. Bank will take it. You buy the home at 10 lakhs. After a few years, you can understand, right? Prices will go up. So they will take the money. Banks are happy. These people are happy. They will get some money also. So the borrowers will get money. The banks get money. They will refinance it. Basically, sell it to someone else and recover the cost. Now, if it is 1 or 2 people, it's fine, but you're giving it to thousands of people who don't have, again, no salary, no assets. So what they'll do, when they come for mortgage payment, they say that, please take it. We're okay with it. Now, if everyone started giving back, the bank cannot resell this. Everyone is selling the home. So imagine that I have 1 lakh homes to sell. The demand is only 50,000. 50,000 homes get it's not solved. So that means that prices start will coming down. Instead of 15, initially we said that no, the 12 lakhs, 13 lakhs will be the interest plus principal plus interest is 12, 13 lakhs. Home price is 15. If everyone selling home, instead of going to 15, the land price and home price goes down to below 12, 13, even below 10 or 8. If that happens, it's a loss for the bank because bank cannot sell it. This is what housing bubble is all about. So it's about lending by the banks for those people who cannot repay. They know that they cannot repay it, but what they believe is that we can get the home and we can sell it to someone else and recover our cost. So this is how the banks and the borrowers by the individuals, see why I am investing in. If forget about those people who are borrowing. If I have salary also, if I am investing in my home, what is my thinking? Wait, let's understand it. Which is the most safest investment? You invest in banks, you invest in home, or you invest in gold? You ask anybody with a salary and family, guys, that they invest in home. Am I right? Most probably will say that. So people who don't have, who also have salary and gold, they still invest in their homes. Based on their homes, in America, there is a system like reverse mortgage. Now, I invest in my home. I am now around 60, 70, I retired. What I can do is that I can give that, I can give that home to, I can pledge the home to another bank for an income for me. After I die, bank will take my home, and till that I can get a decent income also. So I'm 70. My home price is what said 10 lakh rupees. I can ask 10,000 rupees per month. I believe that I'll live another 15 years. I'll get that amount. I die, bank will take it, sell it, and get the money back for them. So those people were also affected. Those old age people, initially I expect my bank to give me 10 lakh, my value of my home is around 15 lakhs. Suddenly it's coming to 10 lakhs, 8 lakhs. Even those people started getting affected. Okay, this is the larger picture. Now, coming back to subprime mortgage. Now, what they did is take this all the homes, like thousands and lakhs of homes. Just like imagine it's like a huge company, make it into shares. So you know that, right? 1 crore rupee share, or 1 crore rupee company, make it into 10 rupee share. You'll have 10 lakh shares. Just like that, they put into share. The only thing is that people who are going to repay it, then only the share prices of that, the home prices or the credit defaults, that prices actually increases, and they put in the stock market. This Lehman Brothers, they borrow money 1:30. Their capital is only 1. They borrow 31 rupees and then buy those mortgage-backed securities. And if the prices goes down around 4 to 5%, their whole entire capital is wiped out. This is what happened, and I hope that I explained the whole thing. Any more questions?
There are a few more questions.
Okay.
Can you please explain NTSDC?
What is NTSDC? What is NTSDC? I never use this word.
Okay, then maybe,
what is this? I
Abhijit.
don't know what.
Okay, so maybe then we'll skip on to the other question. Can you please explain call option and put option once more?
Okay. Again, let's understand. So option means like you have an option to buy or sell it. So call option means I have a right to buy it. എനിക്കാണ് അവകാശം വാങ്ങിക്കാനുള്ള അവകാശം എനിക്കാണ്. വാങ്ങിക്കണോ വിൽക്കണോ എന്നുള്ള തീരുമാനിക്കാനുള്ള അവകാശം എനിക്കാണ്. അപ്പുറത്തുള്ള ആൾക്ക് പ്രത്യേകിച്ച് അവകാശം തരാൻ ആൾക്ക് നിർബന്ധമായിട്ടും വിറ്റിരിക്കണം. So I want to, if I'm going to buy it, the other person has to sell it. That's basically call option. The call option is I have a right to buy. Call means buy. And put option, I have a right to sell. The other person has the obligation to buy it. I have a right to sell it. The other person have an obligation. I have an option to sell. This is what it is. So if so generally what happens is that call means if the prices go up, and you want to buy it at that time, it's a loss for you, right? So you have an agreed price of, say, the price is at present is 80. I have an option for 60. അപ്പോൾ എനിക്ക് ഓപ്ഷൻ ഉണ്ട്, എനിക്ക് വാങ്ങിക്കാം. അപ്പൊ മറ്റേ ആൾക്ക് ഉറപ്പായിട്ട് 60 രൂപയ്ക്ക് വിൽക്കണം. സോ മാർക്കറ്റ് പ്രൈസ് 80 ആണ്, എനിക്ക് വാങ്ങിക്കാൻ പോകണം. എൻ്റെ കയ്യിൽ 5 രൂപയുടെ കോൾ ഓപ്ഷൻ ഉണ്ട്. I can buy it at 60. I buy it at 60. Rather, what happens is that 20 രൂപ ലാഭത്തിന് വരും, we just exchange for that margin amount, which is like 20 minus 5, I get 15. The same with put option. Put means I have an option to sell it. The other person has to buy it. If the price goes down, 50 രൂപ 20 രൂപയായി കുറഞ്ഞിരിക്കുകയാണ്, then we agreed upon some amount. He has to buy it at that amount, 60 rupees. Irrespective of what happens, you have to exercise it. So you buy it at 5 rupees, but actually initially you will lose 15-20 rupees. Rather, you can settle for 5 rupees. This is the basic thing about put option. Any more questions, or do you think that they want one more clarification?
See, any more questions? If you have any more questions, you can unmute yourself and talk. And if the people who have asked questions, if it is not clear to them, you can unmute yourself and maybe you can ask for clarification.
Okay. Can you explain swap in Malayalam? Okay, fine. Probably, see, swap എന്ന് പറഞ്ഞാൽ, so രണ്ട് കമ്പനി ഉണ്ട്, say ഒരു കമ്പനി ഉണ്ട്, ABC എന്നൊരു കമ്പനി ഉണ്ട്. Then we have ഒരു പെൻഷൻ ഫണ്ട് ഉണ്ട്, ഉദാഹരണത്തിന് LIC പോലെ ഉണ്ട്. So ABC എന്നൊരു കമ്പനി ഉണ്ട്, LIC എന്നൊരു കമ്പനി ഉണ്ട്. Then you have another company like AAG. മൂന്നുണ്ട്. So AAG is insurance, or give me a pension. Okay, fine. A company, pension fund, insurance. മൂന്ന് പേരുണ്ട്. Company want to raise capital, and company want to share that. Company want to raise money from, say the pension fund. But pension fund ധാരാളം കാശുണ്ട്. സോ $1 billion ആണ് കമ്പനിക്ക് 10% പലിശയ്ക്ക് കൊടുക്കുന്നു. സപ്പോസ് കമ്പനി ഈ പറയുന്ന മറ്റേ പെൻഷൻ ഫണ്ടിന് $1 billion തിരിച്ചടക്കാൻ പറ്റില്ലെങ്കിൽ, എങ്കിൽ പെൻഷൻ ഫണ്ട് എന്ന് വെച്ചാൽ ആലോചിക്കണം, നമ്മുടെ അച്ഛനും മുത്തശ്ശന്മാരുടെ ഒക്കെ പലരും പെൻഷൻ കൊണ്ടായിരിക്കണം. അപ്പൊ അത് ഒരിക്കലും they don't want it to sell it for a higher, they don't lose that money. Pension paisa ഒരിക്കലും നഷ്ടപ്പെടാൻ പറ്റില്ല. So what the pension company will do is that they'll go to the insurance company and say that I will give you, insurance company will say that don't worry, ആ കമ്പനി നിങ്ങൾക്ക് പെൻഷൻ ഫണ്ടിന് കാശ് നൽകുമ്പോൾ ഞങ്ങൾ തരാം, ഞങ്ങൾക്ക് 1% ഇൻട്രസ്റ്റ് തന്നാൽ മതി. So what happens is that pension company or the pension fund give loan for 9 rupees. കാരണം 10 രൂപ 10% പലിശ കമ്പനി തരുന്നു, ഇൻഷുറൻസിന് 1 രൂപ കൊടുക്കണം. അപ്പൊ പെൻഷൻ കമ്പനിക്ക് 9 രൂപ, ഇൻഷുറൻസുകാരന് പുറത്തേക്കൊന്നുമില്ല, 1 രൂപ കിട്ടി. പക്ഷെ കമ്പനി that give you 10 rupees. ഇതാണ് ഇതിന്റെ സെറ്റപ്പ്. Now കമ്പനി ഒരു $1 billion കൊടുത്തില്ലെങ്കിൽ എന്ത് പറ്റും? ഈ ഇൻഷുറൻസ് കമ്പനി ഷുഡ് പേ ദ പെൻഷൻ ഫണ്ട് ആ $1 billion കൊടുത്തിരിക്കണം. അതാണ് ഈ പറയുന്ന സ്വാപ്പിന്റെ പ്രത്യേകത, ക്രെഡിറ്റ് ഡിഫോൾട്ട് സ്വാപ്പ്. അതാണ്. അതായത് നിങ്ങൾ കടം കൊടുക്കുന്ന ആള്, ക്രെഡിറ്റ് മീൻസ് കടം, റൈറ്റ്? ഡിഫോൾട്ട് മീൻസ് തിരിച്ചടയ്ക്കാതിരിക്കാം. സ്വാപ്പ് മീൻസ് മറിച്ചൊരാൾ ചെയ്യാം. ഇതാണ് ക്രെഡിറ്റ് ഡിഫോൾട്ട് സ്വാപ്പ് എന്ന് പറയുന്നത്. അപ്പോൾ ക്രെഡിറ്റ് എന്ന് വെച്ചാൽ കടം, ഡിഫോൾട്ട് എന്ന് വെച്ചാൽ തിരിച്ചടയ്ക്കാതിരിക്കാൻ വെക്കാം, സ്വാപ്പ് എന്ന് വെച്ചാൽ മറിച്ചൊരാൾ തരിക. അപ്പോൾ കമ്പനി ഈ പറയുന്ന ബോണ്ട് അല്ലെങ്കിൽ ലോണ് പെൻഷൻ ഫണ്ടിന് എടുത്തത് തിരിച്ചടക്കാൻ പറ്റില്ലെങ്കിൽ ഇൻഷുറൻസ് ആരൻ ആ പെൻഷൻ ഫണ്ടിന് കാശ് കൊടുക്കണം. ഇതാണ് ക്രെഡിറ്റ് ഡിഫോൾട്ട് സ്വാപ്പ് എന്ന് പറയുന്നത്. Any more questions, or do you any part I want to explain in Malayalam? I'm okay with it. എന്തെങ്കിലും ഒരു പാർട്ട് മലയാളത്തിൽ എക്സ്പ്ലെയിൻ ചെയ്യണമെങ്കിൽ I'm okay also with that.
So hope all the doubts are clarified. Okay, and since no more doubts are there regarding the session, I will go on with the MBA entrance examination. See, the student. Okay, thank you. I see so many yeses, so the doubts are kind of clarified. Thank you very much. And the students of Mount Sinai College had requested that they wanted to know more about the MBA entrance examinations and what is the admission procedure of MBA in Kerala. So I will give you a brief about that. So MBA goes like this. See, you know what is the importance of MBA in your career? When you finish your graduation, you will definitely be doing any PG. So if you do any PG, maybe if it is MCOM or MSc or any PG that you do, you will definitely get a job. No doubt about it. And after 2 years, what will you do? After 2 or 3 years, when you want to climb the ladder, you will need some managerial experience or some managerial qualities. So then the company will say either to climb to go to the to become a manager or to become an assistant manager or to become a whatever managerial position, you will need an MBA because that is where you become a better manager. So then you will have to do an MBA. You will have to either close your education, you'll have to either quit the job and then do the MBA. So you'll be losing a start in your career. So that is when doing an MBA after your degree matters. So you അതിർത്തിയിലേക്ക് ഒരു തോക്കും കൊണ്ട് അതിർത്തിയിൽ പോകുന്ന പോലെയാ. നമ്മൾ അതിർത്തിയിൽ ഒരു തോക്കും കൊണ്ട് പോയി കഴിഞ്ഞാൽ എനിമീസ് ഉണ്ടാവും. നമ്മളെ ഒരു തോക്കിൽ തുണ്ട കഴിഞ്ഞാൽ കഴിഞ്ഞു. See, you lose there. So that is how MBA can save your career. MBA can save your career by giving you a good kickstart your career and make it a better one for you in future. So I'll tell you how you can get an MBA degree in Kerala. You will have to, if you are planning to do an MBA in Kerala, you will have to either qualify CAT, CMAT or KMAT. There are 3 entrance examinations. CAT is conducted by IIMs, that is Indian Institute of Management, for which the application process for CAT 2020 has already begun. It started on 5th and the exam will be held in November. And the next exam is CMAT. CMAT is conducted by All India Council for Technical Education. The exam will be the call for the registrations will begin somewhere in end of September or maybe end of August or September, and then the examination will be in the month of January. And the next examination is KMAT. KMAT is conducted by Controller of Entrance Examinations under the guidance of Admission Supervisory Committee. രണ്ട് KMAT examination ആണ് നമുക്ക് ഒരു വർഷം ഉണ്ടാവുക. ആദ്യത്തെ KMAT examination ഡിസംബറിലും രണ്ടാമത്തെ KMAT examination ജൂണിലും ഉണ്ടാവും. ആദ്യത്തെ ഈ വർഷത്തെ ഡിസംബർ 2020 ഫസ്റ്റ് KMAT എക്സാം, ജൂൺ 2021 സെക്കൻഡ് KMAT എക്സാമിനേഷൻ ഉണ്ടാവും. ഡിസംബർ എക്സാമിനേഷൻ രജിസ്ട്രേഷൻ ഓഗസ്റ്റ് അവസാനം അല്ലെങ്കിൽ സെപ്റ്റംബർ ആദ്യത്തോടുകൂടി ഉണ്ടാവും. കാരണം ഈ വർഷത്തെ അഡ്മിഷൻസ് ഇതുവരെ കഴിഞ്ഞിട്ടില്ല. അതുകൊണ്ടാണ് നമുക്കിപ്പം അടുത്ത KMAT എക്സാമിനേഷൻ നോട്ടിഫിക്കേഷൻ ഒന്നും വരാഞ്ഞത്. അല്ലെങ്കിൽ ഈ സമയം കൊണ്ടൊക്കെ അടുത്ത ഡിസംബറിലേക്കുള്ള KMAT നോട്ടിഫിക്കേഷൻ വരേണ്ടതായിരുന്നു. അപ്പൊ കോവിഡ് ഒക്കെ കാരണം നമ്മുടെ അഡ്മിഷൻസും ക്ലാസ് സ്റ്റാർട്ടും ഒക്കെ വൈകിപ്പോയി. സോ എനിവേ ഒരു ഓഗസ്റ്റ് അവസാനം അല്ലെങ്കിൽ സെപ്റ്റംബർ ആദ്യമൊക്കെ ആയിട്ട് ഇതിന്റെ നോട്ടിഫിക്കേഷൻ വരും. അപ്പൊ ഞാൻ ദീപ മാമിനെ അതിന്റെ നോട്ടിഫിക്കേഷൻ അറിയിക്കാം. സോ ഷീ ക്യാൻ ഇൻഫോം യു ഓൾ. ഇനി അത് എങ്ങനെയാണ് എക്സാം ക്രാക്ക് ചെയ്യേണ്ടത്? ഈ എൻട്രൻസ് എക്സാമിനേഷൻ CAT ഒഴിച്ച് CMATും KMATിലും ഒക്കെയും 4 സെക്ഷൻസ് ആണുള്ളത്. ജനറൽ നോളേജ് ഉണ്ടാവും, ഇംഗ്ലീഷ് ഉണ്ടാവും, റീസണിങ് ആൻഡ് ക്വാണ്ടിറ്റേറ്റീവ് ടെക്നിക്സ്. അപ്പൊ ഇത് 4 CATന് റീസണിങ്, ക്വാണ്ടിറ്റേറ്റീവ് ടെക്നിക്, ഓക്കെ, റീസണിങ്, ക്വാണ്ടിറ്റേറ്റീവ് ടെക്നിക്സ് ആൻഡ് ഇംഗ്ലീഷ് മാത്രമേ CATിലുള്ളൂ. CAT 300 മാർക്കിലാണ്, CMAT 400 മാർക്കിലാണ്, KMAT 720 മാർക്കിലാണ്. അപ്പൊ ഇതിനൊക്കെ നമുക്ക് ഓരോ കട്ട് ഓഫ് ഉണ്ട്. ജനറൽ കാറ്റഗറി ആണെങ്കിൽ കേരളത്തിൽ അഡ്മിഷന്റെ കാര്യമാണ് ഞാൻ ഈ പറയുന്നത്. കേരളത്തിൽ അഡ്മിഷന് ജനറൽ കാറ്റഗറി ആണെങ്കിൽ 15% മാർക്ക് വേണം. SC BC അതായത് OEC OBC കാറ്റഗറി ആണെങ്കിൽ 10% മാർക്കും, SC ST കാറ്റഗറി ആണെങ്കിൽ 7.5% മാർക്കുമാണ് വേണ്ടത്. ഇപ്പൊ ഈ ടോട്ടൽ മാർക്ക് ഇപ്പൊ CATിലാണെങ്കിൽ നമുക്ക് ജനറൽ കാറ്റഗറി ആണെങ്കിൽ 45 മാർക്ക് വേണം, SC BC കാറ്റഗറി ആണെങ്കിൽ 30 മാർക്ക്, SC ST കാറ്റഗറി ആണെങ്കിൽ 22.5 മാർക്ക്. അതുപോലെ CMAT ആണെങ്കിൽ ജനറൽ കാറ്റഗറിക്ക് 60 മാർക്ക്, SC BC കാറ്റഗറി ആണെങ്കിൽ 40 മാർക്ക്, SC ST കാറ്റഗറി ആണെങ്കിൽ ഐ തിങ്ക് 30 മാർക്സ്. KMAT ആണെങ്കിൽ ജനറൽ കാറ്റഗറിക്ക് 108 മാർക്ക്, SC BC കാറ്റഗറിക്ക് 72 മാർക്സ് ആൻഡ് SC ST കാറ്റഗറി 54 മാർക്സ്. അപ്പൊ ഇതാണ് കട്ട് ഓഫ്. ഈ കട്ട് ഓഫ് കൊണ്ട് നിങ്ങൾ എന്താ ഉദ്ദേശിക്കുന്നത് വെച്ചാൽ നിങ്ങൾ MBAക്ക് എലിജിബിൾ ആണ്. MBAക്ക് നിങ്ങൾക്ക് അപ്ലൈ ചെയ്യാം, അഡ്മിഷൻ എടുക്കാം. പിന്നീട് എലിജിബിലിറ്റി എന്ന് പറയുന്നത് 50% ഡിഗ്രിയിൽ അഗ്രിഗേറ്റ് വേണം. ഇത് എലിജിബിലിറ്റി മാത്രമേ ആവുന്നുള്ളൂ. ഇനി എത്രത്തോളം മാർക്ക് കൂടുന്നുവോ അതനുസരിച്ച് നിങ്ങൾക്ക് സ്കോളർഷിപ്സ് കിട്ടും, യൂണിവേഴ്സിറ്റീസിൽ അഡ്മിഷൻസിന് നിങ്ങൾക്ക് അപ്ലൈ ചെയ്യാം. അപ്പൊ ഈ KMAT-ന്റെ മാർക്കിനെ ബേസ് ചെയ്തിട്ടാണ് യൂണിവേഴ്സിറ്റി അഡ്മിഷൻസ് ഒക്കെ നടക്കുന്നത്. അപ്പൊ നിങ്ങൾ ഏത് യൂണിവേഴ്സിറ്റി, ഇപ്പൊ ഈ ഞങ്ങളുടെ അവിടെയും ഞങ്ങൾ സ്കോളർഷിപ്പ് കൊടുക്കുന്നത് KMAT-ന്റെ മാർക്കിനെ ബേസ് ചെയ്ത് കൊടുക്കുന്നുണ്ട്. അതുപോലെ തന്നെ UG ഡിഗ്രിയുടെ പെർസെന്റേജിന്റെ ബേസിസ് കൊടുക്കുന്നുണ്ട്. ഈ വർഷമാണെങ്കിൽ ഞങ്ങൾ KMAT 120 മുതൽ 200 വരെ ഓരോ സ്ലാബിലായിട്ട് ഞങ്ങൾ സ്കോളർഷിപ്പ് കൊടുക്കുന്നുണ്ട്, 5,000 to 25,000 വരെ. അതുപോലെ ഡിഗ്രിയിലാണെങ്കിൽ 65% to 80% ഓരോ സ്ലാബിലായിട്ട് 5,000 മുതൽ 25,000 വരെ സ്കോളർഷിപ്പ് കൊടുക്കുന്നുണ്ട്. അപ്പൊ നിങ്ങൾക്ക് എത്രത്തോളം മാർക്ക് കൂടുതൽ കിട്ടുന്നോ അത്രത്തോളം സ്കോളർഷിപ്പിന് നിങ്ങൾ എലിജിബിൾ ആവും. അപ്പൊ അതാണ് KMAT-ന്റെ ഇമ്പോർട്ടൻസ്. അപ്പൊ നിങ്ങൾ കുറച്ചൊന്ന് KMAT-നെ പ്രിപ്പയർ ചെയ്യണം. അത് ഞങ്ങൾ അടുത്ത വർഷത്തേക്ക് നിങ്ങൾ KMAT നോക്കുകയാണെങ്കിൽ ഞങ്ങൾ തന്നെ ഇവിടെ ഓൺലൈനായിട്ട് എല്ലാ വർഷവും ഞങ്ങൾ KMAT-ന്റെ കോച്ചിങ് കൊടുക്കാറുണ്ട്. ഇപ്പൊ ഈ ലാസ്റ്റ് ജൂൺ 2020 KMAT ഞങ്ങൾ ഓൺലൈനായിട്ടാണ് കോച്ചിങ് കൊടുത്തത്. അതുപോലെ തന്നെ ഇനി അടുത്ത ഡിസംബറിലേക്കുള്ള KMAT ഞങ്ങൾ ഓൺലൈനായിട്ട് കോച്ചിങ് തുടങ്ങും. അപ്പൊ അതിന്റെ രജിസ്ട്രേഷൻ നോട്ടിഫിക്കേഷൻ ഒക്കെ ഒന്ന് വന്നു കഴിഞ്ഞാൽ വി വിൽ സ്റ്റാർട്ട് ദ കോച്ചിങ്. അതും ഞാൻ നിങ്ങളുടെ ടീച്ചേഴ്സിനെ ഇൻഫോം ചെയ്യാം. യു ക്യാൻ ഓൾസോ പാർട്ടിസിപ്പേറ്റ്. ഇനിയിപ്പോ നിങ്ങൾ അതിൽ അധിക പേരും BBA സ്റ്റുഡൻസ്, ഇപ്പൊ മൗൺസിയിലെ കുട്ടികൾ അധിക പേരും BBA സ്റ്റുഡൻസ് ആണ്. അപ്പൊ BBAക്ക് എങ്ങനെ നാച്ചുറൽ പ്രോഗ്രഷൻ എന്ന് പറയുന്നത് MBA ആണ്. നമുക്ക് MCA പറ്റിയൊക്കെ ചോദിച്ചിട്ടുണ്ടായിരുന്നു. MCAക്കും എൻട്രൻസ് ഉണ്ട്, പക്ഷെ MBAയുടെ എൻട്രൻസിനെ പറ്റിയാണ് എനിക്ക് കൂടുതലായിട്ട് അറിയുള്ളൂ. MCAയുടെ അഡ്മിഷൻ ഡീറ്റെയിൽസിന്റെ കാര്യം എനിക്ക് കൂടുതലായിട്ട് അറിയില്ല. അപ്പൊ അതുകൊണ്ട് ഞാൻ അതിനെപ്പറ്റി അറിയാത്തതിനെ പറ്റി ഞാൻ പറയുന്നില്ല. MBAയുടെ നിങ്ങൾക്ക് BBA എന്നല്ല ഏത് ഡിഗ്രി കഴിയുകയാണെങ്കിലും once you enter the job after 2 or 3 years, if you are looking for a managerial position, you will have to do an MBA. ഇനി ഡിസ്റ്റൻസ് MBA ചെയ്തുകൂടെ എന്ന് നിങ്ങൾ ചോദിക്കും. ഡിസ്റ്റൻസ് MBAയും റെഗുലർ MBAയും തമ്മിൽ ഒരുപാട് വ്യത്യാസമുണ്ട്. ഡിസ്റ്റൻസ് MBAയിൽ നിങ്ങൾക്ക് ഒരു ഗൈഡൻസ് കിട്ടുന്നില്ല. അപ്പൊ നിങ്ങൾ തന്നെ പുസ്തകം എടുക്കുന്നു, പഠിക്കുന്നു, എഴുതുന്നു. ഒരു MBAക്ക് ഇത്രയും വാല്യൂ വരുന്നതും MBA ഇത്ര ഒരു എലീറ്റ് ഡിഗ്രിയായി മാറുന്നതും നിങ്ങൾക്ക് ആ ക്യാമ്പസിൽ കിട്ടുന്ന എക്സ്പോഷർ ആണ്. MBA ഒരിക്കലും നമുക്ക് എല്ലാ യൂണിവേഴ്സിറ്റീസിലും MBA പ്രൊവൈഡ് ചെയ്യുന്നുണ്ട്. പക്ഷെ നമ്മളൊരു ഒരു കാൻഡിഡേറ്റ് ഇന്റർവ്യൂവിന് വരുമ്പോൾ നമ്മൾ അവരോട് ചോദിക്കുന്നത് ഏത് കോളേജിലാണ് നിങ്ങൾ MBA പഠിച്ചതെന്നാണ്. നമ്മൾ ഏത് യൂണിവേഴ്സിറ്റിയിലാണ് പഠിച്ചെന്ന് ഒരിക്കലും ചോദിക്കില്ല. കാരണം ആ കോളേജിനാണ് ഒരുപാട് ചേഞ്ചസ് ഈ വ്യക്തിയിൽ വരുത്താൻ കഴിയുക. MBA is not about gaining knowledge. ബുക്കിഷ് ആയിട്ടുള്ള നിങ്ങൾക്ക് എന്തൊക്കെ അറിവുണ്ടെങ്കിലും, എന്തൊക്കെ മാർക്കറ്റിംഗ് തിയറി നിങ്ങൾക്ക് അറിയാണെങ്കിലും, എന്തൊക്കെ HR തിയറി അറിയുകയാണെങ്കിലും, അതൊന്നും ഈ പറയുന്ന ടെക്നിക്കൽ നോളജ് ഒന്നും കൊണ്ട് നിങ്ങൾക്ക് MBA പ്രത്യേകിച്ച് യാതൊരു ഗുണം ഉണ്ടാവില്ല. MBAക്ക് വാല്യൂ വരുന്നത് തന്നെ നിങ്ങൾ എങ്ങനെയാണ് ഒരു മാറ്റം വരുത്തുന്നത്, ഒരു ട്രാൻസ്ഫോർമേഷൻ ആണ് MBA ഉദ്ദേശിക്കുന്നത്. നിങ്ങളുടെ പേഴ്സണാലിറ്റിയിൽ, നിങ്ങളുടെ ഔട്ട്ലുക്കിൽ, നിങ്ങളുടെ ഇന്ററാക്ഷൻസിൽ നിങ്ങൾ എങ്ങനെയാണ് ഒരു പ്രോസസ് നിങ്ങൾക്ക് തരുമ്പോൾ നിങ്ങൾ എങ്ങനെയാണ് അത് ആ പ്രോജക്റ്റിന് നല്ല രീതിയിൽ ഔട്ട്പുട്ട് കൊണ്ടുവരുന്നത്. ഇതൊക്കെയാണ് MBA ഡിഗ്രി നിങ്ങളിൽ വരുത്തുന്ന മാറ്റങ്ങൾ. അപ്പം പൊതുവെ ഇപ്പൊ MBA ഗ്രാജുവേറ്റ്സിനെ ഞങ്ങൾ സ്റ്റുഡൻസിനോടൊക്കെ പറയാനുള്ള MBA ഗ്രാജുവേറ്റ്സ് എന്ന് പറയുന്ന ഫാസ്റ്റ് ഫുഡ് പോലെയാണ്. അപ്പൊ നമ്മളൊരു ബർഗർ കഴിക്കാൻ നല്ല വിശക്കുമ്പോൾ നമ്മൾ ബർഗർ കഴിക്കാൻ പോകും അല്ലെ, അല്ലെങ്കിൽ എന്തെങ്കിലും ഫാസ്റ്റ് ഫുഡ് കഴിക്കാൻ പോകും. നമുക്ക് അവിടെ കുക്ക് ചെയ്യാൻ നേരമില്ല, അടുക്കളയിൽ പോയി ഭക്ഷണം ഉണ്ടാക്കാൻ നേരമില്ലാത്തത് കൊണ്ടാണ് നമ്മൾ ഈ ഫുഡ് പുറത്തുനിന്ന് വരുത്തുന്നത്. അതുപോലെ തന്നെ കമ്പനീസിന് ട്രെയിൻ ചെയ്യാൻ നേരമില്ല. ഒരു ഡിഗ്രി ഗ്രാജുവേറ്റ്, ഒരു അണ്ടർ ഗ്രാജുവേറ്റിനെ എടുത്ത് 6 മാസം ട്രെയിൻ ചെയ്ത് അവർക്ക് പണി പഠിച്ചു വരുമ്പോഴേക്കും അവർ ആ ജോലി ഇട്ടെറിഞ്ഞു പോകും. അപ്പൊ അങ്ങനെ അവരെ ട്രെയിൻ ചെയ്ത് കമ്പനിക്ക് പൈസ കളയാൻ വയ്യ. അതിനാണ് അവർ MBA ഗ്രാജുവേറ്റ്സിനെ റിക്രൂട്ട് ചെയ്യുന്നത്. സോ ദാറ്റ് MBA ഗ്രാജുവേറ്റ്സ് കം സ്കിൽഡ്. അവർ ഫാസ്റ്റ് ഫുഡ് പോലെ അവർ സ്കിൽഡ് ആണ്. അവരോടൊരു കാര്യം ഏൽപ്പിച്ചു കഴിഞ്ഞാൽ അത് വ്യക്തമായി വൃത്തിയായിട്ട് ചെയ്യാൻ അവർക്കറിയാം. കാരണം അവരത് കോളേജിൽ നിന്ന് പഠിച്ചിട്ട് പോകുന്നുണ്ട്. അപ്പൊ ഞങ്ങളൊക്കെ അഹല്യ ഇസ് എ പാർട്ട് ഓഫ് എ കോർപ്പറേറ്റ് ഗ്രൂപ്പ്. അപ്പൊ ഇത് തന്നെ ഒരു ബിസിനസ് ഗ്രൂപ്പാണ്. ഇവിടെ തന്നെ അവർക്ക് ഒരുപാട് എക്സ്പോഷർ കിട്ടും. അപ്പൊ അങ്ങനെ ആവുമ്പോൾ നിങ്ങൾ കോളേജിനാണ് ഒരുപാട് ഇമ്പോർട്ടൻസ് വരുന്നത്. സോ ഇനി നിങ്ങൾ പുറത്തേക്കാണ്, കേരളത്തിന് പുറത്താണ് അഡ്മിഷൻസ് നോക്കുന്നതെങ്കിൽ ഈ KMAT എഴുതേണ്ട കാര്യമില്ല. കാറ്റിനും CMAT-നും ഒരുമാതിരി എല്ലാ കോളേജസിലും അക്സെപ്റ്റൻസ് ഉണ്ട്. ഇനി അതല്ലാതെ കേരളത്തിന് പുറത്ത് പോവുകയാണെങ്കിൽ ഓൾ ഇന്ത്യ മാനേജ്മെന്റ് അസോസിയേഷന്റെ MAT എക്സാം ഉണ്ട്, മാനേജ്മെന്റ് ആപ്റ്റിറ്റ്യൂഡ് ടെസ്റ്റ്. അതും നിങ്ങൾക്ക് എഴുതാം. സോ ആദ്യം നിങ്ങൾ തീരുമാനിക്കേണ്ടത് നിങ്ങൾ എവിടെയാണ് പഠിക്കാൻ ഉദ്ദേശിക്കുന്നത്. കേരളത്തിലാണോ പുറത്താണോ? പുറത്താണെങ്കിൽ ഏത് കോളേജാണ്, ആ കോളേജിൽ ഏതൊക്കെ എൻട്രൻസസ്. കാരണം നമ്മൾ ഉദ്ദേശിക്കുന്ന പോലെയല്ല, കേരളത്തിൽ സെൻട്രലൈസ്ഡ് ആണ്, എല്ലാവരുടെയും ഒരേ എൻട്രൻസേ അക്സെപ്റ്റ് ചെയ്യുള്ളൂ, CAT, CMAT or KMAT. പക്ഷെ കേരളത്തിന് പുറത്ത് അങ്ങനെയല്ല, ഓരോ കോളേജസിനും അവരുടേതായിട്ടുള്ള റിക്വയർമെന്റ്സ് ഉണ്ടാവും. അപ്പൊ അത് നിങ്ങൾ മനസ്സിലാക്കണം. എന്നിട്ട് അതനുസരിച്ച് ആ എൻട്രൻസ് എക്സാം എഴുതണം. സോ അതിന് ഫെർദർ ആയിട്ട് എന്തെങ്കിലും ഹെൽപ്പോ സപ്പോർട്ടോ വേണമെങ്കിൽ യു കെൻ ഓൾവേസ് കോൾ മീ. എന്റെ നമ്പർ 9496000133. ഐ വിൽ ബി ഏബിൾ ടു ഗൈഡ് യു ഓൺ ദാറ്റ്. ഇനി ഇപ്പോഴത്തെ സാഹചര്യത്തിൽ കേരളത്തിൽ MBA ചെയ്യുന്നത് എന്തുകൊണ്ട് നല്ലതാണ്, എന്താണെന്ന് വെച്ചാൽ കേരളം ഇപ്പോൾ വേൾഡ് വൈഡ് ആയിട്ട് അറിയപ്പെടുന്ന ഒരു സംസ്ഥാനമാണ്. എന്താണെന്ന് വെച്ചാൽ നമ്മൾ ഡിസാസ്റ്റർ മാനേജ്മെന്റിൽ അത്രയ്ക്കും എഫക്റ്റീവ് ആണ്. നിപ്പ ഹാൻഡിൽ ചെയ്യുന്ന സമയത്തും 2 ഫ്ലഡ് ഹാൻഡിൽ ചെയ്യുമ്പോഴും ഇപ്പോഴത്തെ ഈ കൊറോണ ഹാൻഡിൽ ചെയ്യാനും നമ്മൾ ഡിസാസ്റ്റർ മാനേജ്മെന്റ് വി ഹാവ് പ്രൂവൺ ourselves. അപ്പൊ അതുകൊണ്ട് കേരളത്തിൽ നിങ്ങൾ ചെയ്യുമ്പോൾ നിങ്ങൾക്ക് യു ക്യാൻ സേവ് എ ലോട്ട് ഓഫ് മണി. ഇവിടെ നിങ്ങൾക്ക് 3 ലക്ഷത്തിൽ ഒരു MBA കഴിയുകയാണെങ്കിൽ പുറത്തേക്ക് നിങ്ങൾ പോവുകയാണെങ്കിൽ ഡെഫിനറ്റ്ലി ഇപ്പം തമിഴ്നാടാണെങ്കിലോ കർണാടകയാണെങ്കിലോ ഒക്കെ ആണെങ്കിലും നിങ്ങൾ ഇതിന്റെ ഇരട്ടി സ്പെൻഡ് ചെയ്യേണ്ടി വരും. ഇവിടെ ചെയ്യുമ്പോൾ നിങ്ങൾക്ക് യു ഗെറ്റ് വാല്യൂ ഫോർ യുവർ മണി. നല്ല എഡ്യൂക്കേഷനും കിട്ടും, പേരും ഉണ്ട്, അതിന്റെ ഒപ്പം തന്നെ നിങ്ങൾക്ക് പൈസയും സേവ് ചെയ്യാൻ പറ്റും. സോ ഇപ്പൊ കേരളത്തിൽ ചെയ്യുന്നതിനെ പറ്റി നിങ്ങൾ ചിന്തിക്കുന്നതായിരിക്കും ഏറ്റവും നല്ലത്. ഇനി ഇതിനെപ്പറ്റി ഫർദർ ആയിട്ട് എന്തെങ്കിലും അറിയണമെങ്കിൽ യു കെൻ ഓൾവേസ് കോൺടാക്ട് മീ. ഞാൻ നമ്പർ പറഞ്ഞിട്ടുണ്ട്. ഇനി ഞാൻ ഞങ്ങളുടെ ഫീഡ്ബാക്ക് ഫോം ഞാൻ ചാറ്റ് ബോക്സിൽ ഇടാം. എല്ലാവർക്കും ഈ പാർട്ടിസിപ്പൻസിൽ എല്ലാവർക്കും സർട്ടിഫിക്കറ്റ്സ് നമ്മൾ പ്രൊവൈഡ് ചെയ്യുന്നുണ്ട്. അപ്പൊ അതിലേക്ക് നിങ്ങൾ എൻ്റർ ചെയ്യൂ ആൻഡ് സർട്ടിഫിക്കറ്റ്സ് വിൽ ബി സെൻഡ് ടു യു. Give us 2 days time. And now I welcome Jisha, MBA first year student, Jisha, to propose the vote of thanks. And if you chat box, Google form, you can fill it. Jisha, are you available?
Hi, yes, ma'am.
Yeah, please go ahead.
Good evening, all. It gives me an immense pleasure to deliver the vote of thanks for the event. First of all, I would like to thank the speaker of the webinar, respected Danu sir, for his effort towards the valuable information about derivatives and financial markets. Thank you, sir. Thank you very much. Also, I would like to extend a special thanks to our respected principal, Ashokan sir, for the presence. Thank you, sir. Next, I would like to thank all those organizing team, teachers, and staff members of Ahalya School of Management. Thank you very much. Last but not least, I would like to thank all the participants for joining. Thank you so much. Have a great day. Thank you.
So thank you all for spending this 1.5 hours with us. Thank you very much. Deepa ma'am, I take this opportunity to thank you because you are the anchor behind this. You are the one who said that why can't we do a webinar on this? And as it's actually, it was charted out for a webinar for the Mount Sinai students, but then since it was on a virtual platform, we extended to all of you. So thank you very much. Thank you, all of you to be a part of us. And then we will have similar webinars going forward too. I will let all of you know about it.